Hello there and welcome to the Hashpower Academy. My name is Jake Scanlon, and here at the Academy we learn anything and everything about Bitcoin and its underlying network. But in this topic we're going to go upwards, but to start we start from the bottom. And the context of this conversation is to delve into the future of mining, the risks, and the worries about the amount of subsidy per block in decline and the amount of fees per block needing to increase as the income for miners. And we start with the energy sector because this is the cost side of Bitcoin mining. It is their input, and it's the input to the Bitcoin network. So Bitcoin mining hardware consumes electricity from the energy sector. The compute sector, producing compute power, hash power, and hash power finds the next block in the chain. And the blockchain is where all the rules for Bitcoin come into play that layer 2's are looking to, shall we say, escape from. That is to say that Bitcoin blocks come every 10 minutes approximately. But if you were going into a shop and trying to buy a coffee, you wouldn't want to wait 10 minutes for your settlement of a transaction. And if millions of people are all buying coffee, there is not enough transaction space in those blocks. And so we have base layer 1 Bitcoin units of, well, BTC, but there are also people developing layers, so new forms of layers on top of Bitcoin that use the security of Bitcoin and its proof of work model as those fundamental foundations, which is the right way to go about things in the context of allowing a wider pool of people to trade, transact in Bitcoin. But what's happened over time before we had highly adopted layer 2's was, well, when there's lots of transaction demand and limited space for transactions to be stored, the fees in which people have to pay to access settlement right now, as in within the next 10 minutes, versus if you try and pay a lower fee, your settlement of your transaction isn't stored in space, a block, but it's stored in time. And this is where the mempool kicks in. It's a place in which nodes are tracking all of the different transactions that are requesting to be added to the blockchain. And they're essentially categorized based on the willingness to pay a fee. The highest fee paying transactions will probably get into the next block. And so that communication between the mining layer and the layer 2's is fundamental. The piece in the middle is settlement. The settlement space is limited in storage size, the amount of data. And so layer 2's offer efficiency, and what happens is that efficiency is traded for fees going to the layer 2 layer and layer 2 nodes earning those fees. But those fees might not necessarily make their way to the miners, because what's happening is there's going to be an ever increasing amount of data the higher you go up in the layers, but it also constrains the amount of fees in Bitcoin terms going to the lower layers of the network. And you have to pay miners. But the debate right now is to all the different ways of providing income to miners. From my perspective, there are several different income streams from all these different layers for miners. But mining is going to be a fundamental part of the discussion before the dollar, during the dollar, and after the dollar in terms of Bitcoin. And so looking at how layer 2's race to ensure that you can pay someone near immediately, pay a small fee, and every now and again access the layer, well, the layer 2 has all the settlement of your transaction for convenience. But those layer 2, the amount of Bitcoin in the layer 2 in reference, there are still IOUs, just remember that. The layer 2's have to reference and settle eventually on the layer 1. So the frequency in which transaction optimization finds its way to the layer 1, where those fees are paid to miners, well, that's the big question looking forwards. And that is to say that the most valuable commodity to any layer 2 is hash power. Banking, finance, any form of institution that wants to use layer 1 block space, you either pay to play, which is paying Bitcoin to access block space, or you produce it yourself with hash power from the mining side. And so I always find that anything to do with the expression of Bitcoin in financial terms and that demand for a place to settle transactions, for the final record of information of how much was sent to whom, well, that all comes from the mining side. And so mining is always going to have an important discussion when discussing any new updates to the Bitcoin chain and improvisations and different layers that abstract away from the rule structure, which is 10-minute blocks and certain amount of storage space per 10-minute period. All of these things come together to say that it's inevitable that the amount of subsidy per 4-year period is getting cut in half, cut in half, cut in half, all right? With not too good drawing. And the amount of fees, let's just put it in black, the amount of fees are going to be minuscule, but they'll increase eventually. Think of these as the 4-year cycles. And we'll have a point in which fees per block is more than the 50% than the subsidy per block. And that point in which subsidy drops below as a percentage of total block rewards than fees, I believe that will be the turning point in which not just Bitcoin unit of account and medium of exchange fundamentals really kick in and we move away from store at value, but also in terms of layer 2's. These layer 2's have got to really offer just as much competitive value in comparison to their connection to other different markets as well. And what I mean by that is the pricing system right now of Bitcoin in of itself is, well, fees right now are barely a fraction of the total block rewards to miners. And so subsidy is buying Bitcoin miners time, but subsidy is issuing that full 21 million supply. On the fee side of things, fees represent some form of economic activity. And that economic activity, whether it's a convenient amount of large, high volume of transactions in a layer 2 with some form of regular settlement rate into layer 1, where those fees are paid. But if block space is constrained by such a small amount of data, there is going to be an inevitable path where it's about transaction optimization, net settlement, which is to say that if, let's just say there's 2 Bitcoin banks in the future and they operate some form of layer 2 to communicate transactions between these 2 banks. Let's say at the end of a certain day, let's say they try and do once a day settlement to the layer 1. If bank number 1 sent 100 Bitcoins worth of Bitcoin on the layer 2 to bank number 2, and bank number 2 only sent 20 Bitcoin in settlement to the others, they would just perform a net settlement of 80 in the middle. And that net settlement would be in the layer 1 blockchain. But that still doesn't pay the miners and reduces the amount of fees that they could potentially earn. But that interplay of security and fees is the clear correlation. Layer 1 block space is absolute truth because a network of gigawatts of power is securing that block space. Layer 2's are just as secure as whoever offers the layer 2, the decentralization of the nodes of that layer 2, or if it's a federation, the security of the federation. So everything is this interplay of security, efficiency, accessibility to other markets in terms of Bitcoin's medium of exchange fundamentals. There is a lot to this, but I do believe that compute power is going to have one of the biggest components of that discussion because it's the commodity that produces block space. And yeah, the long-term path for that is not absolutely clear, but I have a few ideas. I'll leave it there. I hope this was an interesting video. I'm not too worried about when subsidy drops below fees because miners have access to different income streams such as selling power back to the grid. So the energy can flow from buying energy to selling Bitcoin, producing it, or selling the energy and buying Bitcoin. So the energy can flow either way round the network. And it's essentially a basic circuit through the internet and through the electrical grid. And that sort of two-way direction of things makes it different to, say, gold mining, where with gold mining you have a cost of processing a load of rock to extract a quantity of value, but it doesn't go the other way. You can only, the rock cannot be sold for its gold value. It doesn't work like that. But Bitcoin does. And so miners that innovate on the energy side will have the best chance. But even if fees decline, what happens is inefficient miners switch off. So if inefficient, let's say half the network were inefficient and switched off because really low fees, the other half of the network, the efficient ones, the efficiency survives, basically. And so we will never reach a point where there is zero mining. In fact, there will be a lot of people that can drive their cost of mining to zero, because if they've already deployed energy production and priced themselves into paying for it, they can accumulate Bitcoin at a rate that people depending on buying electricity from a grid, they will not be able to achieve those same sorts of economic results. And so efficiency wins here. It's meritocracy in its purest form, which is to say that those most efficient with their energy will account the most sats. And layer 2's just express it even further with higher efficiency on the consumption side of things. So that duopoly of energy and finance, as I said, compute's in the middle, and compute is always part of that conversation as the producer, the issuance power within all the different components of the Bitcoin network. I hope this was an interesting video. I hope to see you in the next one. Goodbye.